Let us discuss companies from retail sector.
If we look at DMart showed quarterly sales growth of 20% and profit growth of 22%. Whereas for last 5 years, the growth for this company was 20% and profit was around 23%. So we can see that there has been a consistency in terms of growth rate. When it comes to Trent, then the sales growth was of around 51% and profit growth was around 450%. For 5 years also, sales growth for Trent was 36% and profit growth was 60%. So we can see that Trent has shown a tremendous growth in last 5 years. So and in current quarter also the growth has been great, and that is the reason why we see that company stock price is also doing well. When it comes to Ethos, the growth rate in terms of sales was 21% and in terms of profit was 58%. In last 5 years, the company has shown a CAGR growth rate in terms of sales of around 17% and profit growth of 44%. So we can see that Ethos also is a company which is showing good growth in last 5 years. And for EMIL, though 5 years and 5 years sales and profit growth rate is not available, but in current quarter company has shown a good sales growth of 20% and profit growth of around 100%. So we can see that the growth rate for EMIL is also good. If we compare market cap of these companies, then DMart and Trent has pretty high market cap, with DMart having market cap in excess of 3 lakh crores and Trent is having market cap of 1.6 lakh crores. EMIL has market cap of around 8,600 crores and Ethos has around 6,000 crores. So we could see that there has been a large difference between DMart, Trent and EMIL and Ethos. The reason for high PE for Trent is again its growth rate, and for DMart also PE is around 120, but the company has been able to consistently show a good growth rate.
DMart gave a good run up in last few weeks, so company took support of an increasing trend line at around 3750, and since then it has been doing well. Company has a resistance of around 4600, which it broke, and we can expect it to consolidate on these levels since it has already given a good run up. It will all depend on the next quarterly results. If the results are even a slight miss, then we can expect stock to correct, since the stock price and PE for this company is pretty high. And looking at the growth numbers shown by other companies like Trent, company also needs to show a good growth. Company has in fact suffered because of Trent. DMart, as we all know, is a national supermarket chain with a focus on value retailing. Company offers a wide range of products with focus on foods, non-foods and general merchandise and apparel. In the apparel sector, company is facing hit because of Trent. Trent is also selling products at a cheaper rate, and experience wise the shops of Zudio is better compared to Avenue Supermarts. So this is the reason why company is suffering in terms of its margin. But looking at its long-term performance, company has shown a good growth in last 3 years. Both in terms of sales and profit, company has been showing growth excess of 20%. Overall, this company looks like a decent long-term bet.
Looking at Trent's technical chart, we can draw an increasing trend line. This stock has not given any opportunity for investors to invest in, since it has not gone down to an extent, and it has been continuously going up from 2020. And as we discussed, the reason for this astronomical rise in its share price is attributed to its growth. The company was in losses in 2020, but after that company recovered and has started showing great growth. We can also see that Zudio shops, wherever they are filled with public, and which is also getting reflected in its profit, sales and stock price as a result. It is also a brand of Tata, which also provides it a strength in terms of getting access to capital. Also, it helps build trust, and company doesn't have any issues while raising debt to do expansion. So these are few positives, and as we discussed, company did sales growth of around 51%, net profit growth by around 450%. So everything is good about the company except its valuations. Company is trading at a valuation of around 140. So any miss in its quarterly results will surely impact its performance heavily. But as long as company is growing, there should not be a problem. In recent calls, company mentioned that they currently enjoys market share of 2%, and hence there is a huge runway for growth. So considering all this, Trent should definitely be in our watch list, and whenever investors think that they have got the opportunity, then they should surely see if they can get into this stock. Looking at the technicals for EMIL, company's current trading price is around 224, and the stock price is currently trading near its resistance. It has a range between 225 to 240, which is acting as a resistance for this stock. And if company breaks out, then we can see a good jump in its share price. Company can stock price can expect to go up. If we talk about the PE ratio of the company is 72.
Electronics Mart India is fourth largest consumer durable and electronics retailer in India. The company offers a diversified range of products with a focus on large appliances, mobiles, and small appliances, IT and others. Company is the largest player in southern region, so we can see that company is operating in a high growth segment. If we look at its previous growth also, company showed a decent growth in last few years and is showing consistency when it comes to profit and sales. So this company also surely be in our watch list. If we have a look at the technicals for Ethos, we can see that company is trending around its increasing trend line. Current stock price is around 2475. If it comes down to its trend line, then it can be a good buy. Company has touched an all-time high of around 3000, and if from current levels, if it reaches its all-time high, then it's a potential gain of around 20%. There is a reason for having P ratio lesser than companies like DMart and Trent, and the reason is the market. So company operates in a luxury market. So Ethos is India's largest luxury and premium watch retail player, having 13% share of total retail sales in premium and luxury segment, and 20% share when seen in exclusive luxury segment. So since company operates in luxury market, though it has a decent growth, but still there is a cap. However, good thing about this company is that company can increase its price whenever it wants. So the company is not pretty much affected by inflation, since we know that those who go and buy luxury watches, they don't bother if it is its price is 10% or 50% higher, since the price of the watch itself is pretty high compared to the average. So these are the few advantages with this company. It can surely be in our watch list.